address is the area of stock splits, as I've been getting a lot of questions the last few days about what this all means. So just a couple weeks ago, Apple recently split their stock 4-for-1, Tesla split their stock 5-for-1. And that means if you used to own 1 share of Tesla, say worth $2,000, you now have 5 shares worth $400 each. Now, stock splits certainly aren't anything new. They were common during the late 1990s tech boom. But the split does not change the value of Tesla. What it does do is allow the investor who couldn't afford to buy 1 share of Tesla at $2,000 a share to buy 1 share now that it's valued at only $400. You see, splits mean more shares, not more or less value. Now, institutional investors, think Fidelity or Vanguard, have for years discouraged large companies from stock splits because each share traded creates an additional cost. However, with the dawn of low or even no commission trades, I believe we're on the cusp of what will one day be known as the stock split mania. Imagine for a second the excitement that would ensue if Netflix and Amazon and Microsoft and Costco all split their stock. It mathematically doesn't change the value of any enterprise, but it would certainly drum up more media coverage and excitement pre and post said splits. And I think we can all agree that the media loves to jump on anything these days. But I digress. Back to the financial markets. Now that you understand stock splits, the question becomes, do the Apple and Tesla splits signal the top of the tech market, similar to the final Qualcomm split that we witnessed back in 1999? It's a question that everybody's been asking the last few days. Well, looking back to 1999, which happens to be the year I actually earned my first securities license after 2 years in the industry, I had a front row seat to what happened. The current action in Tesla, which seems to only go up, looks similar on the surface to what happened with Qualcomm. And of course, Qualcomm was up more than 2,500% from 1998 through the end of 1999. Tesla's only up about 1,200%, give or take. And if it doubles, again, I'll look like an idiot, but I'll take the risk. The companies are similar in that Qualcomm was the face of the technological changes that were promised to occur over the next decade in our own country. And today, there's a good chance that smartphone in your pocket is powered by a Qualcomm chip. They have been major players in the development of 4G and 5G technology. And back in 1999, the idea of everyone walking around talking with a phone that talked back to you, gave you directions, and helped you make dinner reservations and buy even event tickets seemed pretty George Jetson. And yet, guess what? Here we are. These days, you see the idea of the battery-powered cars and trucks and putting humans on Mars. Well, that seems pretty futuristic too. And I'm not saying that's all going to happen, but just as Qualcomm's valuation didn't matter until it did, the value of Tesla doesn't matter until one day when it will. And when it finally did matter to Qualcomm, it took 14 years, that's a lot of fingers and toes, before the stock hit a new high. And during those years, many things that Qualcomm was focused on came to fruition, and it remains a highly successful company. However, from the moment of that last split, Qualcomm was a terrible investment for anyone who bought on the hype that would only go up. So the question now becomes, is the general tech market bubble that some say we're currently experiencing the same as what we saw in 1999? And the simple answer is, well, I like it when stocks go up, but I'm also concerned when they go up too fast and valuation doesn't matter. Let's take Zoom for an example. We're all used to Zoom. We've become very familiar with it, even if we didn't want to. But Zoom is at a market cap of over 120 billion on 2.4 billion in revenue. Not even earnings. That's 133% more than the entirety of Target, a company valued at 74 billion and with significant earnings, not just revenue. Now, I'm not trying to knock on Zoom. We all use it and love it, or, well, that may be a stretch. But I'm concerned about the valuations that exist. Again, after 2 decades in this business, I've learned that valuations don't matter until they do. And the last couple weeks have let a little air out of that bubble per se. So no one can argue that Amazon, Apple, or Google, or Facebook are significantly more profitable and financially secure than the companies that existed back in 1999. Let's think about them, like Pets.com or Flowers.com, or this company BarnesandNoble.com, which did not in fact take down Amazon as was predicted by the experts back then. This is why, as tech moves higher, we continue to prune those positions, just as a gardener prunes mature flowers. So, well, will the market top be in tech? Well, I'm watching for two things. One, significant insider selling at tech companies. If the employees that actually work in the business don't think it's a good investment, well, I probably don't either. And then number two, the significant number of IPOs, think initial public offerings, coming to the market during the remainder of the year. We just had Snowball, and now we're about to have Airbnb. And I don't have anything against any of these companies existing on the stock exchange, but if a new company lists, something has to sell to create the funds to buy. So portfolio managers will typically prune the largest positions, and those tend to be tech stocks that have done well. So I'm not selling sell, I'm just saying that history often repeats itself. And you may want to read up on what happened between 1999 and 2001. If you have any questions on this, please feel free to give me a quick call at the office. We can talk back and forth and figure out a solution for you. Thanks.